Now hand the conference over to Mr. Bimal Mehta, Managing Director of Transpek Industries Limited, for his opening remarks. Thank you, and over to you, Mr. Mehta.
Thank you. Good evening, everyone. On behalf of Transpek Industries Limited, I extend a very warm welcome to everyone for joining us on our earnings call today. I am Bimal Mehta, Managing Director of Transpek Industries Limited. Along with me, I have Mr. Pratik Shah, CFO, and Mr. Alak Vyas, Company Secretary on the call. I hope you and your near ones are safe and healthy in these unprecedented times. Our investor presentation post Q3FY21 result is uploaded on Stock Exchange, and we hope you had a chance to look into it. Since some of you may be hearing us for the first time today, we will give you a brief overview about the company, followed by operational and financial performance. As many of you know, we are a 5-decade-old organization which was founded by Sri Govindji Shroff, and we initially started our business of acrylic sheets, but later in early 70s, diversified and entered into chemical manufacturing business. Since then, we have grown and have emerged as one of the most responsible producers and exporters of chemicals in India. Over the years, we have achieved expertise in manufacturing and handling chlorine and sulfur-based chemicals and have developed processes for chlorinated chemicals like thionyl chloride and various acid and alkyl chlorides indigenously. This chlorination chemistry creates opportunities for supply of intermediates and specialty chemicals suitable for multiple end applications. We also do sulfur chemistry. Adding to that, we were the first Indian company to introduce few products like CSC, which is chloroacetyl chloride, and TC, which is thionyl chloride in India, and in fact thionyl chloride even in Asia. Both chlorine and sulfur are very difficult to handle. They are extremely hazardous chemicals, and what differentiates us from others is our ability to handle such seriously hazardous chemicals in very, very large quantities going into thousands of tons. Coming to our product portfolio applications, the products that we manufacture find applications in many industries like polymers, pharma, agrochemicals, flavors, fragrances, and various other paints, pigments, photo initiation, and such other applications. One of the major applications is polymer. We manufacture certain monomers, and our customers buy these monomers from us. They also buy other monomers from others, and then they combine and they make polymer out of that. These polymers are typically very high strength, very strong, high durability, fire resistant, heat resistant kind of material with a very light weight. And because of these properties, they are used significantly in replacement of steel or other metals. And also they are used in various other applications where high strength is required, especially, for example, aerospace or defense, such applications. In pharmaceutical industry, our products are used to produce various products, including some supplements, medications for cold, medications for cholesterol reduction, etc. Some of our products also find application in agrochemicals, where they are used in manufacturing pesticides, herbicides, insecticides, etc. A small proportion of our products are also used in flavors, fragrances, colors, and pigments market. We have our manufacturing facility at a place called Ekalbara, which is near Vadodara in Gujarat, and this is a location which is strategic for various aspects of business, especially one is export connectivity and two, availability of qualified manpower. The plants that we have on our factory location, they are multi-product plants. Of course, some plants are dedicated to products, but then there are multiple plants, so there are multiple products that we can do, and multi-purpose plants also are there. The entire facility is spread over 100 acres. And out of that about 55% is green belt. We have about 35,000 trees, fully grown trees on the site. total production capacity, including the captive consumption of some of the products, is about 66,000 metric ton. We have also in-house full-fledged R&D facility, which is recognized by Department of Science and Technology, Government of India. And our team constantly innovates, test, monitor, inspect, and handle the kind of complex chemistry that we have at various stages. Also, transporting these hazardous chemicals is also a very critical element of our business, and we have a very robust logistics and packaging system, which includes hundreds of ISO tanks. 70 to 75% of our business is exports, and we have built very strong relationship with many multinational, many global chemical giants for almost a period of more than 30 years. And with that, we have a very significant global presence in terms of geography, in terms of customers. We have been able to build very solid reputation with world's leading chemical giants as quality, delivery, service, supply, all this on all these parameters we have been rated very high, and that's why we have been able to build very strong relationship with these global chemical giants. Now coming to the performance, Q3FY21 performance has been lower as compared to Q3 of the previous year because of the impact created by this pandemic, where most of us are affected in some or the other way. However, in the current financial year, we have so far seen a gradual recovery in application segment on sequential quarterly basis. We supply multiple products to multiple large chemical manufacturers in the world, and these large manufacturers have very wide use of their products in different end user industry. Now, this diversification is of course there, but it also changes from time to time with conditions that change or with business cycles that change. For example, currently due to this pandemic, airline business, or as we say aerospace business, is significantly impacted. And so wherever this application of the products of our customer is in this area, like aerospace or automotive or some other such industry, then definitely there is going to be a significant impact on their volumes, on their business. With respect to a long-term agreement that we had announced almost 3 years back, and with one of our major customers, I would like to inform you that there is no change in the agreement, and everything is same as it was agreed upon, and there is absolutely no change. Of course, the overall volumes have been low as the application segments were not doing well. Coming to projects and capex, as announced earlier, the new project has been put on hold. We are periodically reviewing the situation and will announce if there is any change in the status. The capex for 9 months is largely attributable to the replacement and upgradation, and the capex for the coming 2 years will be based on introduction of new products, and we will announce as and when we are going to be making any significant investment. One of the major elements of our focus currently in terms of performance and in terms of strategy is de-risking. What we are trying to do is to reduce our customer and product concentration. However, we all know, and we must understand, and we must note that this customer and product concentration has helped company improve its performance significantly in last 2-3 years. It has brought in good stability in terms of business and very good financial strength. But of course, considering the long-term growth and need to minimize the impact of challenges to specific application segments due to market situation like what has happened in case of this pandemic, the company is working on adding new products and new customers. As a long-term de-risking strategy, the company is targeting balanced volume distribution among 4 to 5 application segments and also customers, and as well as some of the regional balancing is also being focused upon. New products. The company is targeting growth from products having various application profiles like pharma, agro, polymers and plastics, photo initiators, electronics, personal care. Many of these applications we are already doing a lot of new products. We are developing a lot of new products, and they are at different stages of development, and they will be introduced after the completion of development and validation by customers on a gradual basis. I mentioned, we are global business partner for major chemical companies, and we have been their partner for decades. Our long-standing relationship has helped us to grow over the last 4 to 5 years significantly. And at present, we are in regular contact with them, regular talks with them, and we continue to review situation periodically together with them in terms of how the business is going to move forward as soon as this pandemic is over. Or right now, we are seeing some reduction in effect of pandemic and all that, considering all that. For first half of the FY21, business environment was sluggish in terms of the applications that our customers have, and therefore there was lower uptake in volumes from clients. In last 2-3 months, we have seen some volumes improve, but of course, currently there is no clear indication. Yes, there is a belief that the situation is expected to improve gradually. We are making all efforts and getting ready to capture the growth momentum that we will see in the coming period. Thank you. Now I would like to hand over the call to the moderator to open the floor for question and answer session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, you may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question, you may press star and 1. First question is from the line of Dhruv from Monarch AIF. Please go ahead.
Good afternoon, sir, and thank you for taking my question. Sir, my question is regarding to a point that I've seen in the annual report 2020, that there is a supply agreement between the company and Transpek Silox for supply of oleum and sulfur dioxide. So can you please elaborate on this arrangement a little bit? Hello?
Yes, these two products, sulfur dioxide and oleum.
Correct.
Both are the products that are produced during production of other chemicals. So sulfur dioxide is a byproduct, and oleum is a co-product, which is manufactured during the manufacturing of sulfur trioxide. And sulfur dioxide is a byproduct which is generated through our generated when we produce our acid chlorides, which are our main products.
Okay.
Now, sulfur dioxide as a product is used very, in very specific applications. There are not many uses, there are not many customers for that. Transpek Silox has a product where sulfur dioxide is used significantly, and therefore in order to have sustainable sustainable production, because if we are not able to sell our byproduct, then we will not be able to continue with our production. We have entered into an agreement with them, supply agreement with them. And as and when, for example, if we are not able to give sulfur dioxide due to some production issue at our end for a short period of time, maybe we have taken a shutdown and we are not producing enough quantity, then we sell to them volumes which can be converted by them into sulfur dioxide. That's the arrangement. This arrangement based on a cost plus pricing, and because it is typically a byproduct, pricing is not very high, or in terms of margins is also not very high. It is just ensuring sustainability of our sustainable production of our regular products. So that's why this arrangement has been made.
Okay. Thank you for that, sir. So one more thing which I wanted to ask is that in your annual report, you have mentioned that the company sources majority of raw materials, and the number being said is 65% from renowned suppliers. So I wanted to understand, let's say your top 5 raw materials, what is the ratio of domestic sourcing and imports that you do of those raw materials?
Participants, please stay connected. Line for the management is dropped. Ladies and gentlemen, please stay connected while we rejoin the management back to the call. Ladies and gentlemen, thank you for your patience. We have the management connected back to the call. So you may go ahead.
Yes. So raw material, in terms of specific percentages, I don't have the numbers, but just to give you an idea, the major raw material that we use is called TPA, which is largely bought domestically, and another major raw material that we use, which is called IPA, which is imported. Significant quantum of our raw materials, besides the TPA, and the basic raw material which is chlorine and sulfur, most of those raw materials are imported, which are acids in some of the alcohols. Currently, we are not seeing any significant impact in terms of supply chain or in terms of pricing. Yes, out of about say 20 of raw material that we will be using, the main raw material. In case of about 2-3 raw materials, we are facing some shortage, but that is not affecting our demand, our sales or our production, because for those raw materials we are also having limited orders.
Okay. And one last question I want to ask is that now for the long-term arrangement, you have almost supplied to the customer for the last 2.5 years. So what has been the learnings of the company, and how do you see that benefiting us in the long run to other such agreements or contracts which may come as we go forward?
You mean to say that potential for other contracts like this? What you are exactly?
Yeah, so we have this long-term agreement with the customer for 10 years. So what has been the learnings for the past 2.5 years under this contract, which we can apply to our future business actions?
Yes. So basically, similar contracts are also being discussed with other customers. But yes, of course, they may not be same volume in terms of the business size, or they may not be same period. But of course, company definitely has focus on this, and we are already discussing this kind of contracts. Like say, with one customer we are discussing a 2-year contract. With another customer again we are discussing a 2-year contract. So those things are already being worked upon, and as they materialize, then things will become clear. But right now, most of them are in discussion stage.
Thank you very much. And sorry to interrupt you, Mr. Dhruv. I'll request you to come back in the question queue for a follow-up question. A request to all the participants, please restrict to 2 questions per participant. If time permits, please come back in the question queue. The next question is from the line of Ritesh Gandhi from Discovery Capital Management. Please go ahead.
Hi, sir. We've been just looking at the last 11 or 12 quarters, and your EBITDA has been literally all over the place. It goes up, it goes down. There was a large steep rise, which I'm assuming is because of capex sometime in FY20, and then again it came right down. How should we, as people who are slightly newer to the company, actually just get some sort of understanding as what are the drivers for the future? What is the base rate of EBITDA? What is should we be looking at 45 crores, which we did in this December 19, as a regular number, or should we be looking at it as a lower number because of this, because of the cyclicality? How should we be thinking about this?
Hello? May I request to unmute your line from your side, please?
I don't think that you have attended any of our AGMs, but during AGMs, this type of questions keep on coming, and again in earlier calls also. I would like to, inform all the investors, all the shareholders here that because of the nature of business, I would strongly recommend to look at the performance of the company on an annual basis and not on a quarterly basis. Because of there are a couple of reasons for that. One is that the product mix that we have can have different level of profitability. It is not one product company, or it is not one or two product company. Even within the product, we may have different pricing and different profit margins depending on the quality that we supply to the customer, or even depending on the customer, the region, the competitive pressure. So various elements are at play when it comes to profitability. So, for example, if in a particular quarter we have been able to, and we have got orders from customer A where we have higher margin because of better quality that we give, then in that particular quarter you will see higher EBITDA. So I would strongly recommend that you look at our EBITDA on an average basis for the entire year.
Sure.
And
so if we look at FY 19 and 20, we saw a larger jump up from FY 18. And obviously, the last 2 quarters have been slightly, the last 3 quarters have been slightly weak. So we heard some of the commentary. I haven't attended any of your annual, of your AGMs at all, but I heard a couple of calls, still not getting. So should we be looking at sustainable, how should we be thinking about it going ahead? Is what we did in FY 19 and 20, what is a normalized EBITDA, and the last 3 quarters has been exceptional, and how quickly will we be able to go back towards
if you had looked at our presentation, which was uploaded earlier, you could have seen that we have already mentioned that 16 to 20% is going to be the range of EBITDA as we believe and as we expect.
Because revenues have also come off, right? I think in the last couple of quarters, right? Because I think
last 3 quarters revenues have been off because of, as I mentioned, that application segments where our products go have not been doing well. I mean, how many of us have actually traveled by air internationally in last 9 months?
Sure.
Right. So now significant volume of our product goes into aerospace industry, where aircrafts are not being manufactured. Aircraft manufacturing orders or aircraft orders are also being cancelled. So that is where the impact has come from. Some impact has come from automotive business. So that's why the performance is not so good. And that's one of the, in my speech, I already mentioned that one of the de-risking strategies to broad base our application profile in terms of going into various other applications and create a balance among these application segments. So that's what our strategy is. As we move forward into the future, probably this kind of impact may not be there because we will have our application profile spread out. But the same application profile that the performance that you mentioned for last 2 years, the same application where we have significantly focused has given us such a wonderful result in last 2 years and has brought company to a significant financial stability level.
No, so I think, sir, that the question was, so if what I'm hearing from you is the FY 19 and FY 20 numbers, which were almost, 2x of the EBITDA which we did in 18, that should be as automotive and aerospace normalizes. Is that actually a normalized number, or was that a cyclically high number because of some other factors?
16 to 20%. and normalized sales at our capacities would be anywhere between 500 to 700 crores.
Got it. That's the range of the revenue and EBITDA which we expect to make. Got it. And just a last question is with regards to like normalization in aerospace and auto, how long do we see that taking? Is the order book reflecting any improvements already, and how should we be thinking about it?
To be very honest, there is no crystal ball where we can gauge, that how long this pandemic impact will continue and how long this. We were all expecting that things are going to significantly improve, and then we saw a big second wave in UK, Europe, and some other countries. Yeah. Many of these countries are now going again in lockdown. In fact, for example, New Zealand yesterday announced that they are going for a lockdown. It is very difficult to say right now. As I mentioned, we are in constant contact with our customers. We are working together with them, and as situation unfolds, if things improve, then we are geared up. We are ready to take advantage of that situation.
Okay. And just a last question is with regards to actually how specialized are the products which we offer, as in how many, and I know we offer a whole host of them, so it's hard to give actually a broad brush. But if we were to look at, if you were to split all the revenues, how much would it would be like specialized as opposed to kind of commodity like?
Actually, if you look at acid chloride, which is our this is our key product. Acid chloride of different types. It sits somewhere between commodity and specialized products, and they are not exactly highly specialized, but they are also not exactly commodity products. The main product that we have is, the two main products that we have are what we call TPC and IPC, and they both go into polymer segment. We have significant concentration in polymers, which the end application is highly specialized, but our products are not as specialized as the end application.
Thank you very much. Sorry to interrupt you, sir. I'll request you to come back in the question queue for a follow-up question. A request to all the participants, please restrict to 2 questions per participant. The next question is from the line of Ahmed from Unified Capital. Please go ahead.
Yeah, thanks for taking my question. This is in regard to the long-term supply agreement that you had mentioned about with the customer that you announced a few years back. So is it in the nature of a take-or-pay contract, which means we had undertaken a major capex increase from 31,000 metric ton to 66,000 metric ton? So considering the fact, do you have a fallback mechanism where you get some compensation on a yearly basis till the volumes come back to normalcy?
Yeah, the contract is having take-or-pay arrangements within it in terms of expense reimbursement and in terms of cash flow accommodation and in terms of some margins. So that is already being looked upon. But the point is that the contract has this take-or-pay arrangement based on a minimum volume, not reaching a minimum volume. And for the balance volume, there will be a take-or-pay. So yes, it is there.
So which means have we reached the minimum volume for the year, or any compensation would be?
No, we are almost there. We are very short of. Very small quantity is short of the target volume. So for that, we will definitely get the expense reimbursement and cash flow accommodation.
Okay, so that would come in Q4?
Yes.
Okay. And so as regards to the next year, taking FY21 as the base, and your efforts to get into newer product segments in agrochemicals and pharma, could we see a better revenue uptick in FY22, or would it take some time before you crack those customers or crack those products?
It will definitely take some time because product validation. See, we have some products ready. For example, we have already given samples to our customers. What they will do is that they will validate that product in their laboratory first. Then they will come back to us and they will ask for a sample from our pilot facility. So we will give a product from our pilot facility. Then they will validate that product in their pilot facility. Then in most of the pharma and agro products, there is a shelf life concept. So what they will do is that they will put our product aside for certain period of time, maybe say for 6 months or 9 months, whatever is their standard of shelf life, and they will check whether the product is getting spoiled or not. They will also put the product that they have made using our material on the shelf, in the sense that they will also wait for a certain period to see whether that product remains as it is, as it was manufactured. So it's a long-term process, and that's why I mentioned that various new products are at different stages of development. And yes, as things progress, we will start introducing those products. Fortunately, in one or two products, customers are ready. Not significant volumes, but customers are ready. So once that is validated, it will immediately be commercialized. But yes, it is going to take some time.
So, I mean, does that mean sequentially we can grow, or is this 90 crores a new base?
No. Most of the products will go sequentially. Sometimes you can introduce, say, more than one product parallelly also. It all depends on the validation process and customers' comfort with the end product they test, the quality, as I mentioned, the period on shelf and all that.
Thank you very much. A request to all the participants, please restrict to 2 questions per participant. The next question is from the line of Dhanil Desai from iWealth Management. Please go ahead.
Hello.
Go ahead, sir, you're audible.
Yeah. Hi, Bimal bhai. So, 2 questions. So first is, sir, in terms of pharma intermediate side, I think we were working on couple of products which are in the validation stage. So, sir, any updates on that, and kind of tagging along with that? Currently, 70% of our revenue is coming from polymer application. Not asking for next 1 or 2 years, but over a period of time, how do we see this contribution coming down, and how do we see other segment contribution going up? Any roadmap on that you have internally?
So just to repeat what I had said, that what we are trying to do as part of our de-risking strategy is to balance volume distribution among 4 to 5 application segments. So naturally, of course, polymer will still be little higher. Say right now we are at about 70%. It may over period of over next 1.5 to 2 years, or maybe 2.5 years, it will go to about 45-50%. And balance would be in pharma and agro and some other applications. We are also working on introducing some new products which are value-added products, so beyond what we are typically doing. There will be some value that we are expecting coming from that, but that, of course, is again a 2.5 year process. And I think something more also you had pointed out.
Sir, I was asking that those 2 intermediates that you're working on the pharma side.
Yes. So now one intermediate is ready in terms of laboratory scale product, and one intermediate is already being given to 4 or 5 customers for their testing. We are expecting that in another 6 to 8 months' time we will get some understanding on that. Now see, let us also understand one thing which I think would be important for most of the participants of this call to know. That many times the product is developed or rather developed together with the pharma customers, considering the patent expiry that is going to happen. So what they do is that the customers figure out that this product is going to have patent expiry in a particular year, in a particular month, and then they start preparing for them, and then start looking for suppliers of the raw material or intermediates for that particular product. So sometimes what happens that, say for example, Transpek has a product developed which is given to a pharma customer, and they are already testing and everything, but the patent expiry may be happening, say, in October of 2021, as an example. So then, after that only they will be able to start production, and then only we will be able to start supplying these products. But yes, these 2 products are developed. One, in case of one product, samples are already given, and one is ready, and we will be working with customers when the samples are to be sent and all that.
Okay. And sir, kind of, from what you said, so essentially when things normalize on the polymer side in terms of the application segment and the new product starts scaling up in 6, 8 months, 9 months, so it means that we will continue to grow from the earlier base, and we have enough capacity, or do we need to do any significant capex? Can you throw some light on that?
Right now we have adequate capacity because besides the manufacturing facility that we also work with 3 job work locations around our nearby our factory. So we have enough capacity to produce some of these products, and we are not. Yes, capex would be there, but that capex would be largely modification of the plants and some addition of some of the systems or equipment and all that. We are not expecting any huge or significant capex as we speak. But yes, if a new project comes or some new product or some new opportunity comes, we will definitely look for investing into it.
So last question.
Sorry to interrupt you, sir. I'll request you to come back in the question queue. Thank you. A request to all the participants, please restrict to 2 questions per participant. The next question is from the line of Sunil Kothari from Unique Portfolio Management Service. Please go ahead.
Thank you, Bimal bhai. Thanks a lot for this call. Very knowledgeable and everything.
Yes,
sir, my question is, sir, because of this last 1.5 years, this experience and your observation on polymer application, which is not going as per plan because of this external event, you will be little bit more conservative and conscious for not investing in other segments, or your confidence remains as it is and you want to invest further but to expand in other application segments. So broadly, your thought process on this.
So, Sunil bhai, there are 2 elements to this. It's good that you have asked this question. This is very important question. One element is that are we trying to reduce polymer business? No. We are not trying to reduce polymer business. The polymer business in terms of the quantum that we have had earlier, and we expect that as things improve in terms of application segments, gradually there will be further improvement in that volumes that we have today, or those volumes that we have today also. But the idea is that while we do not remove our focus from polymers, we increase our focus on other application segments. We produce products which are going into some other applications like pharma, agro, electronics and other various other applications, so that our product profile becomes a little broader. So, for example, today our polymer business, as I mentioned earlier, is about 70%. Polymer application from our products is about 70%. That may go to about 50%, 55% over some period in the future. And then we increase our focus on, or our percentage allocation over in terms of revenue over the other applications.
That is increasing. That is by increasing other applications.
Yes.
And sir, we are very specialized in terms of this handling hazardous chemical, this type of our supply chain ability. All these things prove that we may not be very some specialized so-called product manufacturer, but we have some edge in terms of this handling. So, with your last some years experience and some R&D on some other segments, which stage we are and how you see any major capex and development over next 5 years? How confident you are with this much many years of experience and this type of relationship with the customer?
So you see, the point is that capex is directly related to the opportunity that you see. So as you are long-term investors, so as you already know, 3 years back we saw an opportunity, and that's why we heavily invested in terms of, considering the typical investment or capex that we do year on year, that was a very significant investment that we made. And as we move forward, we will see we are looking for this kind of opportunities, and once we see this kind of opportunities, definitely there will be capex on cards, and that would be announced. Now, 5-year period in today's scenario, yes, we have a strategy which we are moving or working on, and we are implementing that strategy. But to foresee something over 5 years in today's scenario is very difficult.
Correct. No, fine. Thanks a lot, sir. Thank you very much. Wish you good luck.
Thank you very much. The next question is from the line of Ayush Mittal from Mittal Analytics. Please go ahead.
Good afternoon, sir. Am I audible?
Yes, sir.
Yeah. Good afternoon, Bimal sir. I appreciate the con call. The insights are very helpful. I have two questions. So in the last 3-4 year cycle, we had when we started doing TPC, with the two new key products in polymer, we had I think transformed from the earlier products which were low value and low margin to make more of these products. Now that we are facing the demand issue because of the application in the aerospace, we plan to use this capacity for those same old products. If yes, then how will we make up for the margins and the turnover that we were doing earlier? And in future, if the demand comes back, how do we go back?
So as I mentioned in the answer to the earlier question, the focus on polymer application or focus on those products is not gone. We are not going to reallocate capacities. We have enough capacity to take on other products without compromising the capacities that is going into polymers as of now. So that's not the idea. Idea is to add. Idea is not to reduce and replace. Idea is to add new products, new applications, and utilize facilities which are not dedicated to polymers.
Got it. Okay. So second question is around the capex that we had announced, and just a year and a half back we were short of capacity. We were not having any EC approval to do more manufacturing if there was a need. But because of COVID, we had to shelve this program. Now, in many of the areas, we are seeing very strong demand for chemical industry. So many companies are doing this. While we have not even started going back on this capex plan, what is that reason for the same? Because if we start today, then it will take at least 3 years maybe to kickstart the whole process. So don't you think we should be kickstarting the investment, basic investment phase, EC and all those things, and for the future?
Yes. So basically what we are already looking at is, as I mentioned earlier, we are looking at a broader product profile, and we have already identified few products. Some of them are already being developed, or rather already developed. Some of them are being developed at different stages. So based on that, whatever is required to be done in terms of whether EC is to be taken or whether we can go for product mix change at various sites. As I mentioned earlier, we have about 3 job work sites where we to manufacture. So there is a concept called product mix change. So from product A to product B, you can do the changes without going for an EC, so long as certain conditions are met. So we are considering all that, and based on that, a comprehensive plan will be, has already been done, and we are going to implement that. And as and when need for capex arises, definitely capex will be. But right now, we are not seeing an immediate need for a very significant capex.
Okay. Thank you. Wish you all the best.
Thank you.
Thank you very much. The next question is from the line of Faisal Hawa from HG Hawa and Company. Please go ahead.
Yeah.
Go ahead, sir, you're audible. So the line for the participant dropped. We move on to the next participant. The next question is from the line of Sunil Jain from Nirmal Bang Securities. Please go ahead.
Yeah, thank you for this opportunity. So my question is, what was the capacity utilization in this Q3 and how it is moving in current point of time? Hello?
Bimal, sir?
Just one moment.
Yeah.
So until now, which is April to January, April last year to January this year, the capacity utilization is still around 35%, which includes, of course, our site and Jogwar site, and currently we are at about 65% capacity utilization.
Is it possible to specify what was it in Q3?
Q3 particularly?
Yeah.
Just one moment. I don't have that number immediately. Sorry, I don't have that number right away.
Okay. No problem, sir. And sir, another question was whether there is any difference between the gross margin for polymer product and other products. The polymer product might be having a better margin.
Not necessarily. See, the polymer product has significant volume.
Okay.
But margins are different from application to application, product to product, or even same product going to different applications or different customers, or same product going in different quality. So purity profile, for example, 99.5%, 99.7%, 99.8%, and the pricing will differ. So gross margins differ from product A to product B to product C, and it is not necessary that polymers fetch higher margins. Polymers definitely have much higher volume.
Okay. Good, sir. Thank you very much.
Thank you.
Thank you very much. The next question is from the line of Faisal Hawa from HG Hawa and Company. Please go ahead.
Yeah, Bimal, I'm extremely sorry. Just at the time of connecting, my call dropped. I have two questions.
No problem. How are you?
I'm fine, Bimal.
Okay, please go ahead.
So I have two questions, sir. One is, you said that they have to compensate us for not having lifted enough material through FY 2021. So, is there any chance that they may invoke some kind of force measure or something, and not fulfill the contract, or we may have to go into some kind of further proceedings with them or something like that? That's one. And second, can you brief us on some cost-cutting efforts that we may have undertaken to really get the results better for the same FY? And third is, what kind of labor job can we get done if at all these orders come back? I mean, would the kind of labor job facilities that we have give us another 175, 200 crores kind of a revenue if we get at full steam?
So the first question, to answer the first question, as of now we have no indication or we have no understanding on any force majeure or anything that is going to be there with the contract that we have. The supplies under contract is continuing. Yes, the volumes are low, but the supplies are constantly continuing. Every month there are some orders, and every month the product is going. So we don't see, or we have not been given any indication on force majeure, or we don't see anything as such. Second question, I mean, when you say that cost cutting, yes, we are very conscious of the cost cutting. For example, of course, there are many areas where we have worked on cutting the cost, but I'll just give you one simple example that our average interest cost or cost of borrowing last year was about 7.9%. It is close to about 8%. And right now it is about close to 6%, 6.2%. So how we have been able to do this? We have been able to do this with cash conservation, focus on cash flow, utilizing instruments which are much lower in terms of the finance cost in comparison with the cash credit. Same way, there is a good amount of work which is being done on conservation of energy, cost cutting there. So yes, there is a good focus in terms of keeping our cost within control, reducing, optimizing, and all those efforts are going on.
And the third question about the labor job.
Sorry?
There was a third question about the 2 or 3 sites for whom we pay the rent, and who do labor job for us. So these three units would be able to give us around 150-200 crores extra revenue as and when our orders come back.
Yes.
Okay. So in effect,
we are not paying rent. We are paying them job work charges.
Right.
They do production for us, and we pay job work charges to them.
Yeah, but there are some minimum charges that we give them every month, even if we don't utilize it. Yeah? So it's almost like a
minimum charges. Yes.
Correct. So that could give us any day another 150-200 crores revenue.
Yes. All these three sides combined. Yes.
So, sir, if you could just accommodate one more question. So, are we in talks with Gujarat government to give us any kind of more extension of tonnage requirements as far as the pollution board and all is concerned? Because that could really give us more capex opportunities without much extra capex cost.
Unfortunately, the area where we are, the government is still restricting expansion. But then that's why we have tied up with these three job work facilities, and as we mentioned, we are also paying some minimum charges just to ensure that we have these capacities available and we don't lose on to that, because these capacities are not just capacities, they are permissions also. Permissions to manufacture, the consent to manufacture. So yes, right now there are no new permissions given. We are working with government. We have made representation. Industry associations also have made representation, and there is some discussion going on. We are hopeful, but let us see. As things unfold, we will see what happens.
Thank you. Sorry to interrupt you, Mr. Hava. I'll request you to come back in the question queue. The next question is from the line of Abhisar Jain from Monarch AIF. Please go ahead.
Yeah, thank you, sir, for the opportunity. Sir, just wanted to understand that what kind of capacity do we have at these three job work locations in terms of tonnage, the capacity availability.
One moment, I'll give you the data. All three combined about 1,000 metric ton a month.
Okay, so 12,000 tons per annum, and we have 66 KT at our plant. So on that combined 78 KT, you mentioned 35% utilization for the 9 months, right?
No. See, this 66,000 capacity. Let us just understand very quickly what these capacities mean.
Right.
66,000 metric ton capacity includes products which are used for captive consumption, which is thionyl chloride, which also includes some part of sulfur dioxide, which is also captive consumption, which also includes sulfur trioxide, which is also captive consumption. It also includes capacities for producing byproducts. So it is not simple as that we have 66,000 metric ton capacity in terms of the end product or the final product that we make. So it is very difficult to, it is not difficult, but it is not practical to combine 66,000 and then this 12,000 metric ton. Within 66,000 metric ton, a significant amount of capacity is for captive consumption.
Okay, understood. So, sir, basically the end product capacity in 66 KT will be lower.
Yeah, so that you are aware of what end product capacities are. Just one moment.
Yes.
So about 16,000 metric ton is the end product capacity at our Ekalbara site, and another 12,000 metric ton at three Dobak sites.
Right. And sir, the 35% utilization was on this end product capacity, right?
Yes.
Okay, understood. And sir, on slide 27 in your PPT, you have mentioned the 6 key applications where you are developing the new products. And in this call, you have mentioned that,
many of these are also, at say a validation stage at the customer end. Sir, all I want to know is that in the next 2 years, out of these 6 categories, what is the number that comes to your mind in terms of how many new products can we start to commercialize, or any revenue ballpark figure that comes to your mind? The timing can be up and down, but in the next 2 years, how many number of products and what we can do?
We believe, or we understand that we are going to be introducing at least 3 to 4 new products.
3 to 4 new products, right? And sir, any revenue range for each of them?
Most of these products are, typically if they are being bought on full capacity or full demand basis from us, then anywhere between 10 to 30 crores per product.
Okay, understood, sir. Understood. And sir, just...
Sorry to interrupt you. Sir, I'll request you to come back in the question queue. Thank you. The next question is from the line of Pawan Kumar from Ratnatra Capital Partners. Please go ahead.
Sir, can you just give us an indication of what will be the proportion of revenues from aerospace and automobile industry applications?
See, what I can tell you is that 70% of our product is going into polymer segment. Now, what happens typically is that within polymers, these polymers are used in automotive, used in aerospace, used in defense, used in fire protection, used in construction, used in various other applications. And that particular allocation is typically what customers know, not us, because we supply to customer A and then he will supply to many customers of his, which is having applications in different segments. So for us, it is not very easy to define, but yes, a significant portion, as we know and as we understand from customers, significant portion goes into aerospace. Then a good amount goes into defense and a good amount goes into automotive. These are 3 main application segments. And so that is the only thing that we have understanding of. Our customers don't share this data with us, that how much of that their product goes into different applications.
And automobiles, would these be high-end cars, or how should we understand?
These are typically very high-end cars and some racing cars. So high-end cars, for example, where these polymers are used? These polymers are used in 3-4 areas. One is for brake pads. Because of the friction, there is a lot of wear and tear that can happen, and also there is huge amount of heat generation. Second is clutch pad. Nowadays, of course, clutch is no longer there because of the auto transmission systems, but earlier clutch was. But today, even in high-end cars, particularly racing cars, clutch is still there because they are not auto-driven. So these areas, and then there is something where where a lot of heat is getting generated, but some other parts near that heat is to be insulated, and this kind of material is used. Nowadays, there is a talk of using some part of this polymer in electric cars. The main reason being to keep lightweight.
Mm-hmm.
But that is being talked upon. To the best of our understanding, so far no one has used it, but it is being talked about.
Okay. And do we have only one polymer right now, namely the one we are supplying on the contract side, or do we manufacture 2 or 3 other varieties of that polymer?
No. What we do is, just to repeat, what we manufacture is not polymer. We manufacture chemical for polymer, which is in general parlance called monomer. So we supply monomer. We manufacture 2 monomers, 2 different monomers, and both of them are supplied to not only one customer. They are supplied to almost 6 or 7 different customers. Yes, one customer has very significant volume for us, but it is supplied to 6 to 7 customers. And these are two different monomers.
Thank you very much. I'm sorry to interrupt you, sir. I'll request you to come back in the question queue. The next question is from the line of Abhishek Shah from Malcolm Capital Advisors. Please go ahead.
Hi, sir. Thank you for the opportunity. Bimal bhai, just a few questions. Wanted to understand the new products that you're mentioning. You mentioned polymers are generally high volume, low margin relatively. So can we assume that the new products will be much higher margins than the existing margins of the company in total?
First of all, polymers are, as I mentioned, different margins are there in different polymers. Different application segments or different customers, different regions.
Right.
It's not that necessarily product that we manufacture for a monomer that we manufacture has necessarily low margin. If we have to blend it in a particular ratio with something else, or if we have to produce some specific quality for a particular customer, then margin may be little higher in that. But yes, coming to the new products, we do have focus on two. If you look at our growth strategy, we are looking into it in two different ways. One is adding products which are different applications. So some of them may be regular or normal margin, and some of them may be high margin. Also adding some products where definitely they have high margin, but these are multi-step products. These are more complex products. So yes, once those products get introduced, the margins may improve for that particular product or group of products. And for other products, we are just looking at de-risking, which is adding applications, but with normal margins.
But safe to assume that margin trajectory should be upwards in the coming years. Not discarding this year, but with the value addition that we are talking about, I think we also spoke about adding number of processes in our each of the products that we come up with.
So yes. So the point is that we are focusing on and we are trying to target margin improvement as we move forward in terms of our product profile. That is definitely part of the strategy.
Got it. Just one more clarification in line with the other questions asked previously. In terms of the capacity, you said 16,000 plus 12,000. I understand it might be difficult to quantify, but when you say we are at 65% capacity utilization, I'm just trying to compare it to the peak quarter turnover of 160, 170 crores that we've done. We would be at around 60-65% of that, or peak turnover could be 200 crores per quarter sort of.
So this is very difficult because each product has different pricing. Each product has even the same product may have different pricing from customer A to customer B and
right.
In the region or segment A to segment B. But yes, what you just mentioned in terms of number is largely similar to what can be seen once we have full utilization.
Understood. Just one more thing is, so in March, a lot of chemicals across the board went through serious fall in prices. So one was volume degrowth and second was, a fall in realization. Where exactly do you think, do you see serious realization fall even right now for us, or, pricing wise we are back to where we were, say, compared to last February or last March?
Pricing wise, we have not been affected much because a significant amount of our volume is cost plus pricing. So we have not been affected in that sense. Plus, most of the products that we buy, some of them had definitely seen some reduction in the price, but it was not very significant. So from the perspective of overall reduction in terms of value of our or rather price of our products, we have not seen any significant drop.
Okay, understood. Bimal bhai, just one request finally is that if we can give some predictability in terms of when.
So I'll request you to come back in the question.
No, it's just a single line. Basically, if we can have predictability of when the phone calls are scheduled, because generally most companies have their phone calls scheduled directly, maybe in a day or two after the results. So until the last week, we weren't sure if we were having a phone call at all. So there's some, confusion there. So if there's some level of predictability is there.
I understand your concern. I'm sure all of you will give us some support, that because we are learning to, do these calls. After many years of listing the security, we have only just started doing this phone call every 6 months now. So yes, as we move forward, we will become a little more disciplined in terms of these things.
Thank you so much. We appreciate the cooperation. Thank you.
Thank you very much. The next question is from the line of Jayesh Parekh from JMP Capital. Please go ahead.
Sir, if I have understood from your talk, there are three things. One, currently polymer business, the demand is an issue, and when demand would restore fully, it is not very clear. Number two, as a de-risking policy, you plan to expand into other segments with incremental products. And the third thing, you said that polymer business annual EBITDA could be in the region of 16 to 20%. And you also said that the expansion into other segments, maybe in next 2 years, 3 to 4 products will come with a revenue size of 20 to 30 crores per product. So is my understanding clear that for next 2 to 3 years, the revenue growth will not be much and expansion in EBITDA will not be as similar to specialty chemical as we have seen in the chemical segment currently. Please correct me if my understanding is wrong from our talk.
Two corrections. One is that I mean just to this EBITDA range 16 to 20% is not about polymer business. It is about the company. It is about the entire business.
Yes.
20%. And secondly, so revenue growth that you mentioned from new products is not 20 to 30 crores. As I mentioned earlier, it is in anywhere between 10 to 30 crores that we are looking at. So some products may have 10 crores, some products may have 12 crores, and some products may have 13, 14, 15, or even 20, 25, 30 crores.
Yes.
So over next 2 years, we are seeing some of these products getting introduced, and based on that, some volume improvements will happen, and definitely some margin improvements should happen. But more importantly, what we believe is that this current products that we have, which go into polymers.
Yes.
That we believe that as the things become little better, we don't have exact understanding on when, because nobody has exact understanding on what things will happen when, considering the current pandemic situation. But we do believe that in the coming time, I mean not very distant future, this volume should start to get better in terms of the current product supplies.
Yes, sir.
So probably maybe say next quarter or even a quarter after that, we don't know, but somewhere around that possibly the volume should go back or maybe improve little bit, not little bit, but significantly above what we have today.
Should take at least 2 to 3 years for new.
Once they improve, and if we don't see any major situation like what we are seeing today, then we believe that there is consistency, because this particular product, polymers, which are called aramid fibers, they are expected to grow in terms of application every year at about 10%. So we are for next until I think 2027 or 28, there are reports. Some of you only sent me those reports. which say that aramid fiber is going to grow at about 10% every year. So once these things restore, once these things become better, we believe that it is going to be a sustainable volume of business.
Thank you. Sorry to interrupt you, sir. I'll request you to come back in the question queue. I request to all the participants, please restrict to 2 questions per participant. The next question is from the line of Samarth Singh from TPF Capital LLC. Please go ahead.
Thank you for taking my question. My first question is on the pharmaceutical intermediates. When is the end molecule patent expiry for the 2 intermediates, and what is the size of the market here?
These are some of the questions that our customers are not sharing as of now, because they have their own confidentialities that they have to maintain. So what they do is they only give us certain intermediate or some names of the intermediate. They don't disclose end application as of now. They also don't disclose when they are going to start, what particular product is there and when the patent expiry is going to be there. So we don't have any understanding or indication on that. Once they validate the product, once they are comfortable and they are ready to put it into the drug master file, then definitely they will come back to us with all these details.
Okay, thanks. And then just could you tell me the cash and debt on the balance sheet?
Sorry?
The cash and the debt on the balance sheet.
Just one moment, I'll tell you.
Sir, can you hear us?
One moment, just one moment.
Sure.
So to give you a quick idea, we have about 55 crore working capital limits, of which we are right now utilizing only 20 crores due to good cash management. And for the total borrowings, so 40 crores is the total borrowings right now. Deposit? So fixed deposits and bank borrowings, total of 62 crores. And as I mentioned, working capital 20 crores.
So working capital of 20 crores plus bank borrowings of another 50 crores.
Bank borrowings and public fixed deposits, 62 crores.
Okay, and is there any cash and liquid fund investments on the balance sheet?
No, we don't have any liquid investments. What we have is just fixed deposits of about 8 crores and cash balance of about 2 crores.
Okay, thank you.
Thank you very much.
Thank you.
The next question is from the line of Rishabh Makhija, an individual investor. Please go ahead. Rishabh Makhija, may I request you to unmute your line from your side and go ahead with your question, please?
Hi, sir. Thank you for the opportunity. Just wanted to understand one thing. This long-term contract that we have, where we supply polymer, how much would that, in percentage term, how much would that supply be, and what is the end use of these polymers?
Sorry, say that again. How much of that? What did you ask?
The polymers which we supply under our long-term contract, how much of our total supply would go in this contract, and what is the end use by the customer?
Just one moment. I can tell you about the end application. End application is basically what is called, as I mentioned earlier, is aramid fibers. Aramid fibers are, if you have heard about a brand name called Kevlar. Kevlar became famous when it was it was known that it is going to be used in making bulletproof jackets. Then Kevlar became very famous. So this Kevlar is aramid fiber. So what we supply is monomer, and using these monomers, our customer makes polymer, and that polymer is called aramid fiber, which is branded as Kevlar, and another brand name is Nomex. So this is what, but I cannot tell you how much exactly goes under the contract in terms of percentage of revenue, because we have a confidentiality agreement with the customer.
Okay, understood, sir. Just wanted to understand, even if it's possible to quantify in rough percentage terms, because what we are seeing is in the entire segment there are great results across the board, and our company has somewhat been struggling in terms of revenue and EBITDA as well. So just want to understand when we can see recovery and gauge based on our long-term contract.
No, definitely there is a significant drop in terms of the business coming in under this long-term contract. Definitely there is significant drop. But that drop is, as I mentioned earlier in the call, it's because of the end application segment not doing well, which is, for example, aerospace, for example, automotive. Most of the governments are right now focusing on supporting businesses which have suffered due to this COVID situation. So there is tremendous focus away from defense expenditure. Defense is also one major application of this particular polymer. So there is definitely a drop in supplies which are going under this contract. And that is a peculiar situation that we are facing. Many other companies may not have similar situation, and hence some of them would have seen either their business stable or some of them would have grown. Also, we must keep in mind, many of these companies which seem to have grown recently in last 3, 4, 5, 6 months, where their volumes have significantly increased, their businesses have gone through good growth. Many of them were preparing for some of this capacity expansion or adding new products or new chemistry for last 2 to 3 years. For example, I will not name a particular company, but one company was, 3-4 years back they started investing into a particular product, an investment of about 1,200 crores. So what has happened is that investment has now seen the days of, has seen the light of the day, and therefore, in their case, there is a significant jump in terms of their production and sales. What we are looking at, as I have mentioned earlier also, as part of our de-risking strategy, is that to broad base our product profile, so that, when similar situation, hopefully, let us hope that we all of us don't have to face this kind of situation like this pandemic. But life is something which is, unpredictable. So what we are doing is that we are building a de-risking strategy, and we are trying to broad base our product profile so that, we can also grow similarly despite situations or business situation come under pressure.
Understood, sir. Appreciate it. Thank you and God bless.
Thank you.
Thank you very much. Ladies and gentlemen, due to time constraint, that will be the last question for today. I will now hand the conference over to Mr. Bimal Mehta for closing comments.
So it was wonderful talking to all of you. All of you brought out some very interesting questions, and we hope that we have been able to answer all the questions satisfactorily. As the things unfold, as situation changes, if there is any significant change, any significant development within our business or some new opportunities that we see where we need to inform you, we will definitely announce it properly and appropriately. And thank you for joining us on the call. And as mentioned earlier, we will try to become more predictable in terms of the call dates. And thank you very much. And all the best to you. Please stay safe in this situation.
Thank you very much. On behalf of Transpek Industry Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.